Now let's put all of the above together. Let's cover, you know, the following capital budgeting example. Capital budgeting basically means a long-term investment decision, and it also means basically it means calculate the net present value. Technically, there are other methods to evaluate an investment opportunity, like we saw in Chapter 9, such as the internal rate of return approach, the profitability index approach, and the payback period approach. But in the previous chapter, we saw how every approach has its own advantages and disadvantages, but the net present value approach is by far kind of the cleanest one of all. It has the fewest problems with it. Okay, let's look at the following example. Let's say Cal Poly, or more generally, a company, is considering opening a pizza restaurant in the, on campus, right? It will cost $100,000 to buy all the necessary equipment, furniture, and pay for the interior design. So what is $100,000? That's the initial investment. That also belongs to the net capital spending category of cash flows, right? The restaurant will be operating for 4 years, after which all assets are expected to be sold at a market price of $30,000. The restaurant's equipment falls into the 5-year property class under modified accelerated cost recovery systems. Rent and other fixed costs will equal $10,000 per year, and variable costs will be 20% of the sales revenue. 15,000, 20,000, 25,000, and 30,000 pizzas will be sold in years 1, 2, 3, and 4 at $10 each. The management will also need to immediately set aside and keep each year $2,000 in cash to cover unforeseen expenditures, and this amount will be fully recovered by the end of the project's life. Corporate tax rate equals 34%, and annual interest rate is 10%. Is it worth opening this restaurant? So we need to calculate the net present value. If it's above $0, then we will say it's worth opening the restaurant. To find the net present value, we need to discount all cash flows using the discount rate, which is 10%. So what are the cash flows that need to be discounted at 10%? That's the whole point of this problem. We need to figure them out from all this information. The correct first step would be to, sort out anything that may be irrelevant. So are there any dollar amounts that we would call irrelevant? Remember, there are 2 types of cash flows that we call irrelevant from, the earlier slides in this chapter. And the 2 types of irrelevant cash flows are sunk costs, which is something that has already occurred before we would be making this decision regarding the restaurant. Do we have anything like that? Actually, we do not. So we don't have any sunk costs. The other type of irrelevant cash flows is financing expenses, which means anything related to a loan, making payments on a loan. Do we have anything here about taking a loan to cover part of this $100,000 purchase of the equipment? No. So every single number you see here that's given is relevant, which means we will need to use every single number here somewhere in our calculations of the cash flows, which would then be discounted at 10% to find the net present value to figure out if the restaurant is a good idea. So there are kind of different ways how you write down your numbers when you do the math. It's common to use a negative sign for cash outflows when the money is spent, and no sign at all or a plus sign for cash inflows or money received. And that's what I will be, trying to stick to in my calculations. Okay, so kind of going backwards, we need to find the NPV. That would be our last step. If the net present value is positive, then the project should be accepted, right? So that's the evaluation step. But before that, we need to, they actually calculate the net present value. And for that, we will use the total cash flows, discount them at the known discount rate. And this is where we can use the cash flow keys in the financial calculator. So how do you find the total cash flows for the cash flow keys? For that, one year at a time, and that would be our step number 1, we calculate 3 things. First, calculate the operating cash flow, OCF. Second, calculate the net capital spending, NCS. And third, calculate the change in net working capital, or delta, NWC. Once we have 3 for each year, we would then add them up to calculate the total cash flow from this project for each year. Okay, so let's do step 1, calculating operating cash flow for each year. So here's what we are already given. We will sell 15,000 pizzas in the first year, 20,000 pizzas in the second year, 25,000 pizzas in the third year, and 30,000 pizzas in the fourth year. The price per pizza will always be $10 every year. So this allows us to calculate what? It allows us to calculate the sales revenue. Why do we even need the sales revenue? Well, we need to find the operating cash flow. If you go back a few slides where the operating cash flow was first introduced, you would see that there are 4 different formulas that could be used. They all give the same numerical answer. And I explained on those slides that my favorite formula is this one, where it looks at the sales revenue minus production costs. That difference is multiplied by 1 minus the tax rate, and then we add the product of the annual depreciation and the tax rate. This is the so-called depreciation tax shield approach to calculating the operating cash flow for each year. And the reason I'm using this one, and that's what I explained on my earlier slides, is because this is the fastest way to find the operating cash flow. The other versions of this formula have net income or taxes. And for that, you need to do extra calculation steps. So the depreciation tax shield approach does not need as many sort of preliminary calculations for it. Okay, so if you look at this depreciation tax shield formula, then we need 3 big things: sales revenue, production costs, and depreciation for the year. And this is why we are calculating the sales revenue for every year first. And the sales revenue is the number of units times the price per unit. So the number of pizzas multiplied by the price per pizza. What is the sales revenue in the first year? It's 15,000 pizzas multiplied by $10 each, which gives $150,000. For year 2, the sales revenue will be $200,000. For year 3, the sales revenue will equal $250,000. For year 4, the sales revenue will equal $300,000. Okay, so we are done with the sales revenue part of the operating cash flow formula. What else needs to go in the formula? Costs. That's production costs. You can also call it costs of goods sold, COGS. That's what's commonly found in an income statement. Costs here include fixed costs, which are given $10,000 per year, and variable costs. And what was given to us is that to calculate the variable cost, we need to take the sales revenue and multiply it by 20%. So the idea is variable costs, they vary with how much we sell. So if we produce more pizzas, we are employing workers over time, we are paying them higher wages, we are also using more electricity and other utilities, and so that all adds up to higher costs. But fixed costs, on the other hand, are fixed. They don't increase if we produce more pizzas or decrease if we produce fewer pizzas. So maybe we are renting some equipment, right? So it doesn't matter how much we use it. We are just paying a flat fee every month. Anyway, variable costs are 20% of the sales revenue. What are the variable costs in year one? Sales revenue in year one is $150,000. We multiply that by 20% and get $30,000. For year two, it's 20% of $200,000 in sales revenue, which gives $40,000, and so on. In year three, the variable costs will equal $50,000. In year four, the variable costs will equal $60,000. Combining fixed and variable costs gives us total cost for each year. So $10,000 in fixed costs and $30,000 in variable costs gives a total of $40,000 in total production costs during the first year. In years 2, 3, and 4, the total costs are $50,000, $60,000, and $70,000. Okay, so you can put like a check mark next to costs in the OCF formula. So we have the sales revenue, we have the costs, the tax rate is given. What is the depreciation? Okay, so what we know is the furniture and all other equipment falls into the 5-year property class under makers, right? So we can look up the table that shows how much of the asset's value is lost, or what the depreciation is during each year of the product's life. And the percentages under makers are not the same as would be the case for the straight line depreciation. It will be a different percentage, right? A different fraction of initial value that is lost due to depreciation in each year. Okay, so it's 20% in the first year, according to that makers table for the 5-year property class. 20% of what? 20% of the initial value. What's the initial value? That's by default how much we are paying to buy all the equipment in year 0. And that's given, $100,000. So for every year of this 4-year project, we would need to take $100,000, the initial investment or the initial book value, and multiply it by the respective depreciation rate for that year. So for year 1, it's a 20% depreciation rate multiplied by $100,000, which gives $20,000. For the second year, the depreciation rate is 32%, which gives $32,000 in depreciation for that year. For year 3, the depreciation rate is 19.2%, which gives $19,200 in depreciation. And for the 4th year, the depreciation rate is 11.5%, which gives $11,500 in depreciation. Okay, now we have all the components that we needed to find the operating cash flow using the depreciation tax shield approach. So when we put the sales revenue, the total cost, and the depreciation, and the 34% tax rate into this formula, we get for year 1 $79,400, for year 2 $109,880, and for year 3 $131,928. And for the fourth year, $155,710. Okay? So it's a different number for each year. The sales revenue is growing because we are expecting to sell more pizzas. Because we will be selling more pizzas, the variable costs will be growing. That results in higher overall costs, production costs. And on top of everything, we are dealing with the maker's depreciation method, which has a different depreciation amount for each year. Okay, second step, net capital spending for each year. From the last slide, we know what the depreciation amounts are in dollars for each year of this project. If we add them up, that will be the accumulated depreciation. If we subtract the accumulated depreciation from the initial book value of $100,000, we will get the remaining book value at the end of the project, at the end of the fourth year. So $100,000 minus $20,000 in depreciation in the first year, minus $32,000 in depreciation in the second year, minus $19,200 in depreciation in the third year, and minus $11,500 in depreciation in the fourth year, gives $17,300. Why do we need the remaining book value? Because at the end of the last year, we would be selling all equipment. It will be sold as used, right? And that will bring us extra money, right? The sales proceeds. Except even though we are selling the equipment for $30,000, which was given, this is not necessarily how much we'll get to put in our pocket. So what's happening in this problem is something that is going to be worth $17,300 is estimated to sell for significantly more money, $30,000. So it's like we are expecting to sell it at a huge profit. And the IRS is gonna like it because it's gonna ask us to pay tax on that profit. And so instead of being able to put the entire selling price of $30,000 into our pocket, we are gonna, be allowed to put less than that after paying the tax. So long story short, we need to use the after-tax salvage value formula. On one of my earlier slides where I talked about the formula, I showed two versions of it. And I mentioned that it doesn't matter which one of the two versions you use. Mathematically, they give the same answer. So I use the formula which says selling price, $30,000, minus tax rate, 34%, multiplied by $30,000, the selling price again, less the remaining book value, $17,300. When you do the math, you get the after-tax salvage value equal to $25,682. So this is how much we receive, a cash inflow, at the end of the fourth year, on top of the profit from selling pizzas that we did, as the operating cash flow on the previous slide. So the after-tax salvage value is one of the components of the net capital spending. Another one is for year zero, the initial investment, and that's already given. We are going to have to invest $100,000 to buy all equipment, furniture, and so on. So to summarize, the net capital spending related to this 4-year project includes $100,000 spent in year zero and $25,682 received at the end of the fourth year. And there's nothing in years 1, 2, and 3. It's all blank. Okay. Next, calculate project change in net working capital for each year. So what do we know about the net working capital? We know that we would need to immediately set aside $2,000 and keep it at that level each year. So the net working capital will equal $2,000 invested right away. It will remain the same throughout the project and will be recovered at the end of the fourth year. And at the end of the final year, you should always put $0. I mentioned that earlier when I was covering the change in net working capital topic. So we have minus $2,000 in year 0, an immediate drop or investment, right? Cash outflow. Then it's another, well, I shouldn't say another because I don't want to confuse you. You put $2,000 negative under year 1, which indicates that we have the same total amount of cash in our reserve as of end of year 1. So it does not mean that we have added another 2,000. It means that the total reserve is still 2,000 as it was in year 0. And it's still $2,000 at the end of year 2 and at the end of year 3. Now, how does this cash reserve change over time? The immediate change is $2,000 in year 0. Then it does not change, which means you put $0 or, leave it blank for years 1, 2, 3. In the fourth year, because it's recovered, we're going to get our $2,000 back. So the project sort of gives it back to us. Now we are free to use it for anything else where it's more needed. So the $2,000 recovered at the end, you can put a plus sign next to it because it's like a cash inflow. It is a cash inflow. Okay, so we have just calculated the 3 important components of the total cash flow for each year. The operating cash flow, the net capital spending, and the change in net working capital. Notice how the operating cash flow starts in year 1. So we have it for years 1, 2, 3, and 4 because it's profit from selling pizzas, right? And we look at profits as if they're collected at the end of each year rather than continuously throughout each year. Net capital spending is only there for years 0 and 4. Year 0, we buy all equipment. Year 4, we sell it. So cash outflow in year 0, cash inflow in year 4. Change in net working capital, we only have it for years 0 and 4. In year 0, we set aside $2,000 in cash, just in case, to cover any unforeseen repairs. And in year 4, we recover it. So the $2,000 at the end of the fourth year are a cash inflow for us. So notice that there are 2 amounts of money spent in year 0. So it gives us a total of $102,000. And in the fourth year, we have a lot of things going on. There are 3 sources of money for us. First, the operating cash flow, or the profit we make from selling pizzas. Then we have the after-tax salvage value, the money we collect when we sell all equipment that we will no longer need. And the third source of our money is the cash that will be recovered from the project. Okay, so we have our project total cash flows. So year 0, negative $102,000. Year 1, $79,400. Year 2, $109,880. Year 3, $131,928. In year 4, it's the sum of $155,710, $25,682, and $2,000, which combined give a total project cash flow equal to $183,392. What do we do with them? We find the net present value using 10% as the discount rate, which was given. The easiest way would be to use the cash flow keys in the financial calculator. where negative 102,000 would be your cash flow 0, and then the other 4 cash flows will be entered as cash flow 01, cash flow 02, cash flow 03, and cash flow 04. Then you press the NPV button. It asks you to enter the interest rate, I equals, you put 10, save it, and then press compute. What do we get? $285,370.40. Now, last step, evaluate. Well, because the net present value is above $0, the project should be accepted. It's a good project. What we get back in the future, over the future 4 years, years 1, 2, 3, and 4, is greater than $102,000 that would be invested today. So the money that would go in is less than the money that would come back to us, which makes it a great project.